Hi traders, in this video we are gonna look at some common mistakes our traders make when they undertake the challenge. Most of these mistakes can be easily avoided, and since our intention is that you become FTMO traders and be there for as long as possible, we want you to succeed and have the best FTMO experience. The first common mistake is all about the time zones. In FTMO Challenge, we follow Central European Time, or CET. This is the only time zone we follow, so we are not going to evaluate your results by your own time zone, your brokers, or any other time zone. Why is this important? Because of the max daily loss limit. Let's say that you are residing in Tokyo, where you follow the Japan Standard Time. You start your trading day at 10 a.m. and unfortunately it wasn't a good one. On your $50,000 FTMO challenge, you get a drawdown of $2,000 by 1 p.m. of your local time. So you say to yourself that this was enough of trading for today and you want to wait for your max daily loss limit to reset. You jump back to your trading a few minutes after midnight, lose one trade, and you get the message that you violated the FTMO trading objectives. Why is that? Because you started trading at 10 a.m. It was 1 a.m. of CET time, and when you jumped back into trading at midnight, it was 6 p.m. of CET time, the same day. That's why the rules were violated. Confused? Don't worry. In order to not violate this rule, all you have to do is to open time zone converter in your account matrix and select your time zone. Once you do that, you will see in real time how much time is left for your max daily loss rule to reset. Floating loss. There is one more nuance in max daily loss that is sometimes confusing for our traders. To explain this to you in the best way we can, let's have a look at how we calculate the max daily loss limit. Current daily loss equals to the result of closed positions of this day plus result of open positions. For example, let's say you trade FTMO challenge with $100,000. In that case, the max daily loss is $5,000. If you lose $4,000 any given day, your account cannot decline more than $1,000 on that day. Also, it must not go to minus $1,000 in your open losses. This, of course, includes commissions and swaps. Vice versa, if you make a profit of $2,000, then you can afford to lose $7,000, but not more than that. Once again, be reminded that your max daily loss counts your open trades as well. For example, if you are down $4,000 in a day and you open some new trade which ends up with profit but was down to even minus $1,001 at any point, unfortunately it's already too late. This is because at one point you were at a loss of minus $5,001, which is more than allowed $5,000 max daily loss limit. So, how can you avoid this? Well, it's very easy. Always set a protective stop loss and just don't forget to include spread and commissions into your potential loss when you are close to violating the rule. Maximum daily loss is a big topic which we discussed many times in the past, and on our website there is an article called "Why Do We Care About Open Losses?" And there is also a video dedicated solely to this rule which was done by Pavel. Link to both of these resources can be found in the description below. Economic events. In the challenge and verification, you can hold trades during news. It may seem like those significant price movements on macroeconomic reports have great potential for profit, but it is very important to emphasize that trading on demo accounts sometimes does not respect real market liquidity. Only our FTMO traders are not allowed to execute any news trade or close any existing trade on the targeted instrument in the window of 2 minutes before and 2 minutes after the release of the shown news announcements. The news releases schedule can also be monitored in our economic calendar, where these restricted events are marked by a blue ribbon. Because a lot of traders try to make a quick buck when trading news, they quite often end up violating the rules, and the reason for that is slippage and wider spreads. What we highly recommend to everyone is to wait at least those 2 minutes before and after the news, but in most situations even more. Risk in hedging. A lot of traders think that when they hedge their positions, they are completely risk-free. This is not true due to the moving spreads. You have to bear in mind that you buy for ask price and sell for a bid price. Difference between those two is the spread. Because of that, every trade you open is in a small loss when you open it. Spreads are also constantly changing due to market liquidity. During the main economic releases and contract rollovers in commodities and indices markets, we experience very low liquidity, which causes the spreads to widen. This spread widening can cause unusual situations which will lead to violating the trading rules. Because of that, once you are close to violating the trading objectives, we suggest that you close your positions instead of hedging. By the way, in our last video, we showed one cool trick how you can save money on hedging. You will find this in the link in the description. Okay, so this is it, traders. Don't forget to subscribe to our FTMO YouTube channel, follow FTMO on social media, and as always, trade safe.